Before we dive in, it is critical to understand that the information provided in this video is for educational and informational purposes only. It is not intended to be a substitute for professional legal, financial, or insurance advice. Every divorce and personal situation is unique, and the laws can vary significantly by state. Please consult with a qualified attorney, a licensed financial advisor, and a certified insurance professional to get advice that is specifically tailored to your individual circumstances. Making decisions based solely on this presentation could have serious consequences. The final signature on the divorce decree feels like the end of a war. The emotional exhaustion, the legal battles, the gut-wrenching decisions, it's finally over. You think you can finally breathe. And then about 2 weeks later, an official-looking envelope arrives in the mail. It's not from your lawyer. It's not from the court. It's from a massive, faceless insurance corporation. You open it, and your heart plummets into your stomach. The letter is cold and personal and terrifyingly clear. It's a notice of coverage termination. In 30 days, you and your children will no longer have health insurance under your ex-spouse's plan. Suddenly, a tidal wave of panic washes over you. Every sniffle your child has, every potential accident, every routine doctor's visit now has a giant, terrifying $sign attached to it. You thought the fight was over, but you've just been shoved into a brand new, even more confusing battlefield. A battlefield of deductibles, premiums, networks, and deadlines you didn't even know existed. If this story hits a little too close to home, or if it's the exact nightmare you're desperately trying to avoid, then you are in the right place. Because that letter, or one just like it, is a reality for millions of Americans every single year. A recent study found that nearly 70% of individuals going through a divorce cite navigating the complexities of their insurance as one of the most stressful and overwhelming aspects of the entire process, right behind child custody and asset division. Yet, it's the one area that is most often glossed over, misunderstood, or dangerously ignored until it's too late. This video is your definitive guide. It is your roadmap through the insurance maze that follows a divorce in the United States. We are going to break down step by step exactly what you need to know and what you need to do to protect yourself, your finances, and your family. We are not just scratching the surface here. We are going deep on the big four: health insurance, life insurance, auto insurance, and homeowners or renters insurance. We will demystify the jargon that companies use to confuse you. We will expose the hidden, razor-sharp deadlines that can lock you out of coverage and cost you a fortune. And most importantly, we will give you the exact questions you absolutely must ask your ex-spouse, your lawyer, and your insurance agent to ensure you are not being taken advantage of. By the end of this presentation, you will not just understand your options. You will have a concrete, actionable plan. You will know how to secure the best possible coverage at the best possible price, giving you back a sense of control in a time when it feels like you have none. This isn't just about saving money. It's about securing your peace of mind. It's about knowing that if your child gets sick, or you get into a car accident, you are protected. That is a priceless feeling. So why is this so infuriatingly complicated? It's because the system was never designed with you in mind. It was designed by insurance companies and shaped by legal frameworks that view your life-altering event as a qualifying life event, a checkbox on a form. They see you as a policy number, not a person navigating one of the most difficult transitions of your life. They throw around terms like COBRA, special enrollment periods, riders, and beneficiary designations, expecting you to instantly understand a language it took them years to learn. It's an unfair fight, and you're expected to enter the ring the moment you leave the emotional battlefield of your divorce. We are going to change that right now. We're going to translate all of that corporate speak into plain, simple English. We're going to arm you with the knowledge they count on you not having. Here's how we're going to do it. First, we're going to tackle the 80,000-pound gorilla in the room: health insurance. This is where the clock is ticking the loudest and the financial risks are the absolute highest. A single unexpected medical emergency without coverage can lead to financial ruin, wiping out whatever settlement you fought so hard to secure. We will explore every single one of your options, from employer-sponsored plans to the marketplace to the misunderstood beast that is COBRA. And I will reveal the single biggest, most financially devastating mistake that thousands of people make with their health coverage post-divorce. A mistake that is shockingly easy to avoid once you know what it is. After we've secured your health, we'll move on to life insurance. This is the silent protector of your children's future. The one thing that ensures they are taken care of if the unthinkable happens. It is also one of the most neglected aspects of a divorce settlement. We'll discuss why simply removing your ex as a beneficiary isn't enough, and how to structure things to safeguard your kids' financial future, no matter what. From there, we'll shift to the practical, everyday policies, your auto and home insurance. While they might seem less intimidating, untangling these policies is a critical step that often gets overlooked in the chaos. A few simple phone calls armed with the right information can literally save you hundreds, if not thousands of dollars a year. We'll show you exactly what to say and who to call to maximize your savings and ensure you're not overpaying or, even worse, underinsured. This journey is about empowerment. It's about taking one of the most complex and anxiety-inducing parts of a divorce and turning it into a series of manageable, confident steps. It's about building a new foundation for your life, and a solid insurance plan is a cornerstone of that foundation. So, if you're ready to trade confusion for confidence and anxiety for a clear plan of action, let's begin. The very first thing you need to burn into your memory is this. The moment a judge signs your divorce decree, a stopwatch starts ticking. And when it comes to your health and your family's well-being, that stopwatch is incredibly, unforgivingly fast. Let's not waste another second. The first, most critical thing you need to understand is a federal law called COBRA. Now, I know it sounds like a snake, and honestly, for some people it can feel just as venomous to their bank account. But it's also the first potential lifeline you'll be thrown. COBRA stands for the Consolidated Omnibus Budget Reconciliation Act. Forget the name. It's just government speak for a law that says, under certain circumstances, and divorce is one of the big ones, you have the right to temporarily continue the exact same group health insurance you had through your ex-spouse's job. Let me repeat that because the details are everything. It is the right to temporarily continue the exact same health plan. This isn't a new plan. It's not a similar plan. It's literally you staying on the same United Healthcare, Blue Cross, or Aetna plan you were on yesterday with the same network of doctors, the same prescription coverage, the same everything. You and any dependent children who were on that plan can stay on it. This is a huge deal, especially if you or a child is in the middle of treatment for an ongoing medical condition. The last thing you want while navigating the emotional and financial chaos of a divorce is to be told you also have to find a new oncologist, or that your child's therapist is suddenly out of network. COBRA prevents that immediate disruption. It provides continuity when everything else in your life feels discontinuous. But here's where that ticking stopwatch we talked about gets deafeningly loud. This right isn't automatic. You have to choose it. You have to elect COBRA coverage. And you have a very specific, federally mandated window to do it. Typically, you have 60 days to make this decision. 60 days. That's it. The clock for that 60-day window usually starts ticking from the date you receive the official COBRA election notice from your ex-spouse's employer, or the date your coverage would otherwise end, whichever is later. If you missed that 60-day deadline, the offer is gone. Forever. There are no extensions, no do-overs, no "I was busy" excuses. The door slams shut, and that lifeline is pulled from the water. So, the first step before you do anything else is to be on high alert for that notice. It will come in the mail. It will look official and probably a little intimidating. Do not throw it away. Do not put it in a to-do pile that you'll get to next week. Open it immediately. Read it. Calendar the deadline. This single piece of paper is one of the most important financial and health-related documents you will handle during your entire divorce process. Now you might be thinking, okay, this sounds great. I get to keep my doctor, my plan. What's the catch? And my friend, there is a catch. And it is a gigantic one. It's the price. This is the part that causes a gasp of shock for almost everyone. When you were covered under your spouse's plan as part of a family, their employer was likely paying a huge chunk of the monthly premium. Most companies in the U.S. subsidize somewhere between 70 and 90% of the total cost of health insurance for their employees and their families. You only ever saw the small remaining portion, the 10 to 30%, deducted from your spouse's paycheck. You got used to that number. It felt normal. Under COBRA, that employer subsidy vanishes into thin air. It's gone. Now you are responsible for paying 100% of the total premium. All of it. The part you used to pay, and the much, much larger part the company used to pay. But wait, it gets worse. The law also allows the employer to charge you an extra 2% administrative fee on top of that. Let's put that in real numbers because this is where the theory hits the pavement. Let's say the total monthly cost for your family's health plan was $1,800. Pretty standard figure these days. And let's say your spouse's employer was paying 80% of that, which is $1,440. You were seeing the remaining 20%, or $360, come out of the paycheck each month. That was your cost. When you elect COBRA, you are suddenly on the hook for the full $1,800, plus the 2% admin fee, which is another $36. So your monthly health insurance bill has just gone from $360 to $1,836. It has more than quintupled overnight. For the exact same coverage you had yesterday. This is what's called sticker shock, and it is the single biggest reason why many people simply cannot afford COBRA, even if they desperately want to keep their plan. It can be a financially devastating expense, especially when you are also trying to set up a new household on a single income. So why on earth would anyone pay it? Because sometimes it is absolutely the right or even the only logical choice. There are 3 key scenarios where paying that astronomical COBRA premium makes perfect sense. First, as I mentioned, is continuity of care. If you are pregnant, if you are in the middle of chemotherapy, if your child has a chronic condition that requires regular visits with specialists, this is not the time to rock the boat. Changing insurance plans means changing networks, which can mean changing trusted doctors you've had for years. It can mean fighting with a new insurance company to get pre-authorizations for treatments that were already approved. The stability and peace of mind of keeping your existing medical team intact can be priceless, and worth the high cost of COBRA for a few months while you figure out a longer-term solution. Second, consider your deductible. Most health plans have an annual deductible, that amount of money you have to pay out of pocket before the insurance starts paying for most things. If your divorce is finalized in, say, September, and you've already spent thousands of dollars and met your family's $6,000 deductible for the year, starting a brand new plan means starting a brand new deductible. You'd have to start paying all over again from zero. By sticking with COBRA, you keep your progress toward that deductible. You don't have to repay what you've already paid, depending on your medical needs for the rest of the year. Staying on COBRA could actually be cheaper than switching to a new plan with a lower premium, but a fresh, unmet deductible. And third, there's the simplicity factor. Divorce is exhausting. You're making 1,000 decisions under immense stress. COBRA is, in many ways, the easiest option. It's a known quantity. You know the plan, you know the copays, you know the customer service number to call. It's one less thing to research, compare, and stress over in the immediate aftermath. For some, buying that simplicity for a few months is a worthwhile investment in their own sanity. But remember, COBRA is a bridge. It is not a destination. It is a temporary fix, typically lasting for a maximum of 36 months in the case of a divorce. So even if you choose it, you must treat it as a temporary safe harbor while you actively search for a more permanent, more affordable port. It buys you time, but that time is expensive and it is finite. So the big, expensive, familiar lifeline is COBRA. It offers perfect continuity at a potentially crippling cost. But what if that cost is simply impossible for you? What if your new budget just doesn't have room for an extra $1,800 a month? Does that mean you just have to go without insurance, crossing your fingers and hoping no one gets sick? Absolutely not. This is not a choice between COBRA and nothing. There are other options, powerful options. And the most important one is a direct result of the Affordable Care Act, something often called Obamacare. It's the health insurance marketplace. And understanding how to navigate that system, especially with your new post-divorce income, is the secret to finding truly affordable, high-quality coverage. It's the lifeboat that most people don't realize is waiting for them, and it could save you thousands. So let's break down exactly what this system is. We're talking about the health insurance marketplace, also known as the exchange, which was created by the Affordable Care Act, or ACA. Now, I know what you might be thinking. You've heard the political debates, the news reports, the family arguments over the dinner table. But I want you to set all of that aside. Forget the politics. For our purposes today, the marketplace is simply a tool. It's a website. Think of it like Amazon, but instead of buying books or blenders, you're shopping for health insurance plans from private companies like Blue Cross, Aetna, Cigna, and others. The government doesn't provide the insurance. They just run the store. But here is the multi-thousand-dollar difference, the absolute game changer that makes this the single most important option for millions of Americans post-divorce. The store has a massive, built-in discount program. This discount isn't a coupon you clip. It's a subsidy from the federal government designed to make your monthly insurance bill, your premium, affordable. It's officially called the Premium Tax Credit, and it's based on one simple thing: your estimated income for the year. This is why your divorce is the key that unlocks this door. When you were married, your eligibility for this subsidy was based on your total household income. For many two-income families, that number was simply too high to qualify for any significant help. You were expected to pay the full, unsubsidized, often astronomical price for insurance. But now everything has changed. The government no longer looks at your combined income. It only looks at your income. If your income has been cut in half, or if you're re-entering the workforce after years away, your new lower income likely puts you squarely in the sweet spot for receiving a substantial subsidy. Let me give you a real-world example. Let's say Sarah and Tom were married, and together they made $110,000 a year. On the marketplace, they wouldn't qualify for much, if any, help. Their monthly premium for a decent plan might be over $1,000. They divorce. Sarah now has a job making $45,000 a year. She goes back to that exact same marketplace and looks at the exact same plans. But now, because her income is $45,000, not $110,000, the government calculates her subsidy. Suddenly, that $1,000 a month plan might only cost her $200 a month. The government pays the other $800 directly to the insurance company. It's the same plan, the same doctors, the same coverage, but at a fraction of the cost. This isn't a rare occurrence. This is how the system is designed to work. It's a safety net specifically for people whose financial situations have changed. And there is no bigger financial change than a divorce. So, how do you navigate this store? When you log on to healthcare.gov, you'll see plans categorized into 4 metal tiers: bronze, silver, gold, and platinum. It's a simple way to understand the trade-off between your monthly bill and your out-of-pocket costs. Think of it like this. A bronze plan is like a high-deductible plan. You'll pay the lowest possible monthly premium, which is great for your budget. But if you get sick or need medical care, you'll have to pay a lot more out-of-pocket for deductibles and copays before the insurance really kicks in. This can be a good option if you're relatively healthy and mainly want protection against a catastrophic, worst-case scenario. On the other end of the spectrum, you have platinum plans. These have the highest monthly premiums. Your bill will be much bigger each month. But in exchange, your out-of-pocket costs are very low. Your deductible will be small, sometimes even zero, and your copays for doctor visits and prescriptions will be minimal. If you know you'll be using your insurance a lot, have a chronic condition, or simply want the peace of mind of predictable costs, platinum might be the way to go. Gold and silver plans are the middle ground, balancing those monthly premiums with out-of-pocket costs. They are by far the most popular choices, but there is a hidden feature, a secret power-up, that makes silver plans uniquely valuable for many people, and you need to know about this. This secret is something called cost-sharing reductions, or CSRs. It's a second type of subsidy, an extra layer of savings on top of the premium tax credits we just talked about. But here's the catch. You can only get these extra savings if you choose a silver plan. You could qualify for them, but if you pick a bronze or gold plan, you get nothing. Zero. So what do these cost-sharing reductions do? While the first subsidy lowers your monthly bill, this second subsidy lowers your actual healthcare costs. It reduces your deductible, your copayments, and your coinsurance. It makes your insurance fundamentally better. Imagine your deductible on a standard silver plan is $5,000. With CSRs, that same plan might suddenly have a deductible of just $500. A $40 copay for a specialist visit might become a $10 copay. It's a massive upgrade to your coverage for free. Who gets this? Eligibility for these powerful CSRs is also based on your income, but the threshold is a bit lower than for the premium subsidies. Generally, if your income falls below 250% of the federal poverty level, which for a single person in 2024 is around $36,000, you'll likely qualify for some level of cost-sharing reduction. The lower your income, the stronger the reduction. This is why just looking at the monthly premium is a huge mistake. A silver plan might look slightly more expensive per month than a bronze plan, but if you qualify for CSRs, the silver plan could save you thousands upon thousands of dollars over the year if you actually need to use your health insurance. It could be the difference between seeking care and avoiding it because of cost. Now I can see the wheels turning. You're thinking, okay, my income is lower now, I might qualify for these subsidies. But isn't there a specific time of year to sign up? Yes, there is. It's called open enrollment, and it's usually in the fall. But, and this is the most urgent and actionable advice I can give you, divorce changes the rules. Losing your health coverage because of a divorce is considered a qualifying life event. This means the government grants you a special enrollment period. You do not have to wait until the fall. A 60-day window typically opens up from the date your divorce is finalized or the date you officially lose your former spouse's coverage. During this window, you can go onto the marketplace and enroll in a new plan as if it were open enrollment. But if you miss this 60-day window, the door slams shut. You could be left completely uninsured until the next open enrollment period, potentially months away. That's a risk you cannot afford to take. The clock starts ticking the moment the judge's gavel falls. So you have the what? The marketplace. You have the why? The massive subsidies unlocked by your new income. And you have the when? The 60-day special enrollment period triggered by your divorce. This is your lifeboat. But knowing the lifeboat is there and knowing exactly how to get in, what to bring, and how to avoid the common mistakes that could sink you, well, those are two very different things. The application process itself has critical forks in the road, especially when it comes to estimating your income and reporting your household status. Making a mistake here can have serious financial consequences, either forcing you to overpay all year or, even worse, having to pay back thousands of dollars in subsidies come tax time. So let's talk about how to avoid that tax nightmare. When you're filling out that marketplace application, it's going to ask for your projected annual household income. This is the single most important number on the entire form, and it's also the hardest one to figure out when your life has just been completely rearranged. You're not just guessing. You are making an official estimate that the IRS will hold you to. The key here is understanding what the government actually considers income for this purpose. It's not just the number on your paycheck. First, you have your standard stuff: wages, salaries, tips. If you have a job, that's the starting point. If you're self-employed or a freelancer, you'll report your net income. That's your total earnings minus your business expenses. This is a critical distinction. Don't report your gross revenue, or you'll be massively overstating your income and potentially losing out on thousands in subsidies. You also have to include unemployment compensation, any taxable Social Security benefits like disability or retirement, but not supplemental security income or SSI, and most types of retirement income like withdrawals from a 401k or an IRA and pension payments. Investment income counts too. Think interest, dividends, and capital gains. Now, for the really critical part in a divorce situation, alimony. This is where things get incredibly tricky and where a simple mistake can cost you dearly. The rules for alimony changed dramatically because of the Tax Cuts and Jobs Act of 2017. Here's what you absolutely have to know. If your divorce agreement was finalized before January 1st, 2019, then alimony payments you receive are considered taxable income. You must include this money in your projected income on the marketplace application. And if you are the one paying it, you can deduct it, lowering your projected income. However, if your divorce agreement was finalized on or after January 1st, 2019, the rule is flipped. Alimony is no longer considered taxable income for the person receiving it, and it's no longer tax deductible for the person paying it. It's treated like a private transfer of money. So, if you're receiving alimony under a newer agreement, you do not include it in your projected income. This is huge. For two people in identical financial situations, this one date on a piece of paper can be the difference between getting a massive subsidy that makes insurance affordable and getting no help at all. Check your divorce decree. Find that date. It is everything. Just as important is knowing what doesn't count as income. And the number one item on this list is child support. Let me say that again because it's the most common point of confusion. Child support payments you receive are not considered income for the health insurance marketplace. You do not include them in your calculation, ever. The government views this money as being for the child, not for you, so it doesn't count toward your household income when calculating subsidies. Other things that don't count are gifts from family, inheritances, proceeds from a loan like a student loan or a home equity loan, and workers' compensation. Getting this right is just as crucial as getting the income part right. Okay, so you've painstakingly added up all your income sources. The next box on the application is household size. This sounds simple, but again, in a divorce, it's a minefield. Your household for marketplace purposes is defined by the IRS. It's you, the tax filer, plus anyone you claim as a tax dependent. It is not about who lives under your roof or how much of the time they spend there. It is 100% about who you claim on your federal tax return. This is where custody agreements become critically important. Let's say you and your ex-spouse have 2 children. Your divorce decree states that you will claim one child as a dependent on your taxes, and your ex will claim the other. In this scenario, your household size is 2. You and the one child you claim. Your ex-spouse's household size is also 2. them and the other child they claim. It does not matter if both children live with you most of the time. For health insurance subsidy calculations, all that matters is the tax filing status. What if you alternate years? Many divorce decrees state that parents will alternate claiming the children each year. If it's your year to claim both kids, your household size is 3. If it's your ex's year, your household size is 1, just you. This means your eligibility for subsidies can swing wildly from one year to the next, even if your income stays exactly the same. You have to plan for this. You cannot both claim the same child as a dependent for the purpose of getting health insurance subsidies in the same year. The system will catch it, and one of you will be forced to pay everything back. You and your ex must be perfectly clear and in agreement on who is claiming which children in which year, and your marketplace applications must reflect that agreement exactly. Now you might be thinking, this is crazy. My income could change 3 times in the next 6 months. How can I possibly project an entire year's income right now? This is a valid fear, and the system has an answer for it. It's called reporting a life change. This is not optional. It's a requirement of using the marketplace. If your income changes significantly up or down, you are required to log back into your account and update your application. Think of your marketplace account as a living document, not a one-and-done form. Did you get a new job with a higher salary? You need to report it. Did you lose your job and start receiving unemployment? You need to report it. Did you start a side hustle that's bringing in more money than you expected? Report it. This isn't meant to be a punishment. It's your most powerful tool for managing your costs and avoiding that dreaded tax bill. If your income goes up, you report it, and your subsidy will decrease for the rest of the year. Yes, your monthly premium will go up, but you are prepaying what you would have owed the IRS anyway. You're avoiding a massive, painful surprise at tax time. Conversely, and this is even more important, if your income goes down, maybe you had to reduce your work hours or your freelance business slows down, you report that change immediately. Your subsidy will increase, and your monthly premium could drop significantly, providing you with immediate financial relief when you need it most. Failing to report a drop in income is like leaving free money on the table every single month. So, you've navigated the marketplace application, you've meticulously estimated your income, you've figured out your exact household size based on your tax situation. It's a complex process, but it offers a potential lifeline to affordable health coverage. But what if there's another path? What if you didn't have to find a whole new plan, a new network of doctors, and a new deductible? What if you could just keep the insurance you already have? This is where a federal law called COBRA comes into play. And for many people going through a divorce, it feels like a simple, stable lifesaver in a sea of change. But this lifesaver comes with a shocking price tag. And understanding why could save you from making one of the most expensive financial mistakes of your post-divorce life. That's what we're breaking down next. The official term for this option is COBRA. It stands for the Consolidated Omnibus Budget Reconciliation Act. But for millions of Americans going through a divorce, it might as well stand for Catastrophically Outrageous Bill Recurring Annually. When that COBRA election notice arrives in the mail, it often feels less like an offer and more like a threat. You open the envelope, and a number stares back at you that seems impossible. $700, $1,000, $1,500 or more per month for the exact same health insurance you just had. Your first thought is often, this has to be a typo. Your second is pure cold panic. How is it possible that the cost of your health insurance just exploded by 5, 6, or even 10 times overnight? The answer lies in a single, powerful, and now vanished word: subsidy. Specifically, the employer subsidy. This is the dirty little secret of American health insurance that most people are never forced to confront until a life event like divorce rips the curtain away. For all the years you were covered under your spouse's plan, you were living in a heavily subsidized world. You saw the deduction from their paycheck, maybe a couple $100s a month, and you assumed that was the cost of your insurance. But it wasn't. It wasn't even close. That was just your small slice of the pie. The vast majority of the premium, often 70, 80, sometimes over 90%, was being paid for by their employer behind the scenes before that paycheck was ever calculated. Think of it like this. Imagine you've been living in a beautiful apartment for years. The rent is a manageable $500 a month. You love it. It's perfect. Then one day you get a notice that your arrangement is ending. But the landlord says, "Don't worry, you can stay. You can keep the exact same apartment." You're relieved until you see the new lease. The rent is now $2,500 a month. You're outraged. You say, "How can you raise the rent by $2,000? And the landlord replies, "Oh, I didn't raise the rent. The rent was always $2,500. Your former partner's company was just secretly paying $2,000 of it for you every single month. Now you're on your own." That is COBRA in a nutshell. You are now being asked to pay the full, unsubsidized sticker price of the health insurance plan. And if that wasn't painful enough, the law allows the insurance administrator to tack on an extra 2% administrative fee for the hassle of managing your individual account. So you're not just paying 100% of the cost, you're often paying 102% of a price that was already astronomically high to begin with. This is the moment of truth where the real cost of employer-sponsored healthcare becomes brutally clear. That plan that seems so great? Its value wasn't just in the network of doctors or the low copays. Its primary value was the thousands upon thousands of dollars the employer was pouring into it every single year on your behalf. Divorce instantly vaporizes that subsidy, and COBRA is the offer to keep the plan, but at its terrifying true market cost. So why would anyone on earth ever choose this option? Sounds like financial suicide, and for many people it is. But COBRA exists for a critical reason: continuity of care. It's a bridge, not a destination. Let's say you're in the middle of a serious medical treatment. You're seeing a team of specialists for a complex condition, you've already met your $1,000 deductible for the year, and you're just a few $100s away from hitting your out-of-pocket maximum, after which the insurance pays 100% for the rest of the year. If you switch to a new plan right now, the clock resets to zero. You'd have a brand new deductible to meet. You'd have a new out-of-pocket maximum to hit. Your trusted specialists might not be in the new network, forcing you to start over with strangers, potentially delaying critical care. In a situation like that, paying the exorbitant COBRA premium for a few months to finish out the year in your treatment plan could actually be the wisest and, believe it or not, the most cost-effective decision. It provides a seamless, uninterrupted continuation of the exact care you're already receiving. It's an emergency stopgap measure for people in vulnerable medical situations. The danger, the massive financial mistake we see people make over and over again, is when they are not in that specific situation. They're relatively healthy. They only see a doctor for an annual checkup. But they get that COBRA letter, they panic at the thought of being uninsured, and they sign up without ever exploring their other options. They see it as their only lifeline when in reality they're choosing to pay for a 5-star, all-inclusive resort when all they really need is a clean, safe hotel room for a fraction of the price. They lock themselves into paying thousands of dollars a month for coverage they don't fully need, bleeding their savings dry, all because they acted out of fear and a lack of information. The most important thing to understand about that letter is that COBRA is an option, not a requirement. It is your legal right to continue your coverage, but it is absolutely not your obligation. You typically have a 60-day window from the date of the notice, or the date your coverage ends to make a decision. This is not a time to panic. This is a time to be strategic. This is your window to shop. Because while COBRA is one path forward, there's another, entirely different path that was created for this exact situation. It's a path that could offer you excellent coverage for potentially hundreds, or even thousands, of dollars less per month than COBRA. This alternative is the ACA Marketplace, also known as Obamacare. And understanding how it works and how your divorce just triggered a special key to unlock its most powerful benefits is the single most important piece of financial knowledge you need right now. It's the difference between barely surviving and confidently rebuilding. And we're about to walk you through it step by step. So what is this key? It's not some hidden loophole or a complex investment strategy. It's simpler and far more powerful. The key is understanding that in the immediate aftermath of your divorce, you stand at a critical crossroads with two main paths for your health insurance. Path number one is the obvious one, the one that will be mailed to you in a thick, intimidating envelope. Path number two is the one you have to find for yourself, and it almost always leads to a better place. Your ability to see and understand these two paths is everything. Let's start with path number one, COBRA. The letter you receive will be an offer to continue the exact same health insurance you had while you were married, under a law called the Consolidated Omnibus Budget Reconciliation Act, or COBRA. On the surface, this sounds great. No change. You keep your doctors, your network, your pharmacy benefits. Feels safe, familiar, and in a time of overwhelming change, that familiarity is incredibly tempting. It's designed to be the easy button. But then you'll look at the price tag and your heart will drop to the floor. You'll see a monthly premium that might be 3, 4, or even 5 times what you're used to. You'll think it's a typo. It's not. This is what we call sticker shock. And it happens because for the first time, you're seeing the true cost of your health insurance. When you were employed or on your spouse's plan, the employer was paying a huge chunk of that premium, often 70 to 80%, sometimes more. Think of it like a company-subsidized gourmet meal plan. Every month you got a $100 steak dinner, but you only paid $20 out of your paycheck. You never even saw the full bill. Now with COBRA, you're not just paying your $20 share. You're not just paying the full $100 price of the steak. You're also legally required to pay up to a 2% administrative fee on top of it. So that $100 steak now costs you $102, and you're paying for it all by yourself. That's COBRA. It's the full unsubsidized retail price of healthcare. And for most people, it is crushingly, devastatingly expensive. For many, it's simply not an option. And the fear that sets in when you see that number can be paralyzing. You feel trapped, but you are not trapped. This is where we leave the obvious, expensive path and turn onto path number 2, the smarter path. This path is the health insurance marketplace, also known as the exchange, or what many people call Obamacare. And your ticket to get on this path is something called a qualifying life event. Write that down. Qualifying life event, or QLE. This is one of the most important terms you need to know. Normally, you can only sign up for a new health plan during a short, open enrollment period at the end of the year. But certain major life changes like getting married, having a baby, or crucially losing your health coverage due to a divorce, trigger a special enrollment period. Your divorce is a QLE. It's a golden ticket that allows you to bypass the normal waiting period and enroll in a new plan right now. You typically have 60 days from the date your old insurance ends to use this special enrollment period. This is your window. Do not miss it, because here's where the magic happens. When you go to the marketplace at healthcare.gov, the system doesn't care about the high salary your household had when you were married. It only cares about one thing. What is your projected individual income for the coming year? You will input your new single-person income, and based on that number, the system will instantly calculate if you qualify for financial assistance. This assistance comes in 2 powerful forms. The first is the advance premium tax credit, which acts like an instant coupon, immediately lowering the monthly premium you have to pay. The second is cost-sharing reductions, which lower your out-of-pocket costs like deductibles and copays if you pick a silver level plan. Let's make this real. Let's talk about Sarah. Sarah and her ex-husband had a household income of $150,000. Their family health plan was fantastic, but the full cost was $1,800 a month. Her ex's employer paid $1,400 of that, so they only saw $400 come out of his paycheck. After the divorce, Sarah gets the COBRA letter. The cost to continue that same plan for just herself? $950 a month, plus the 2% fee, bringing it to $969. Sarah's new individual income as a freelance graphic designer is projected to be about $48,000 a year. Paying nearly $1,000 a month for health insurance would cripple her financially. She panics. But then she learns about her qualifying life event. She goes to the marketplace website. She enters her age, her zip code, and her projected income of $48,000. The system instantly tells her she's eligible for a significant premium tax credit. She starts looking at plans. She finds a high-quality silver plan from a major provider. The full price of this plan is $550 a month. But after her tax credit is applied automatically, her monthly cost is just $180. Let me say that again. Her COBRA option was $969 a month for a plan that was designed for a high-income family. Her new marketplace plan, which is perfectly suited for her new life and new income, is $180 a month. That's a savings of nearly $800 every single month. That's almost $10,000 a year. That is not just a little bit of help. That is the difference between bankruptcy and stability. That is the difference between sleepless nights and peace of mind. This is the power of understanding path number 2. Now, the marketplace and COBRA are the 2 main roads, but there are a couple of other side roads you should know about. If you are employed and your company offers health insurance, your divorce is a qualifying life event that allows you to enroll in your own employer's plan right away, outside of the normal open enrollment. For many, this will be the simplest and most cost-effective option. You need to talk to your HR department immediately to find out the deadlines and the costs. Don't assume you have to wait until the end of the year. What if your income drops very low after the divorce? You may qualify for Medicaid. Medicaid provides free or very low-cost health coverage to millions of Americans, including low-income adults. Eligibility rules are different in every state, and are based on your new monthly income. Your divorce and subsequent drop in household income could make you newly eligible. You should check your state's Medicaid website to see if you qualify. It is an absolutely essential safety net that you should not overlook out of pride or misinformation. Finally, you might see ads for something called short-term health insurance. Be extremely careful here. These plans are cheap for a reason. They are not compliant with the Affordable Care Act. This means they can, and often do, deny coverage for pre-existing conditions. They can have annual and lifetime coverage caps, and they often don't cover essential health benefits like maternity care, mental health services, or prescription drugs. They can be a temporary band-aid for a month or two if you have a gap in coverage, but they are not a real long-term solution. Relying on one of these plans is a massive financial gamble. So let's recap the hierarchy of choices. Your first and best option is often a new plan through your own employer, if available. Your second, and for many the most powerful option, is a subsidized plan through the ACA marketplace. Your third option, for those with a significant drop in income, is Medicaid. And your last resort, the expensive but familiar safety net, is COBRA. The one to be most wary of is short-term insurance. Understanding this hierarchy, this decision tree, is the key. It's about replacing the panic you feel when you see that COBRA letter with a clear, logical plan of action. It's about knowing you have options, better options, more affordable options. But health insurance is just the first piece of the puzzle. It's about protecting your health today. What about protecting your family's financial future tomorrow? What happens to your life insurance policy after the divorce? Who is the beneficiary? Are you sure? The assumptions people make about life insurance are some of the most dangerous and costly mistakes we see in a post-divorce world. And getting this one thing right can secure your children's future. Or, if you get it wrong, unintentionally disinherit them completely. We need to talk about it. It's called the beneficiary designation, and it's the single most important line on your life insurance policy. It overrides your will. It overrides your divorce decree. It overrides almost everything. It is a direct contract between you and the insurance company, a promise of who gets the money when you're gone. And millions of Americans have it set up completely wrong after a divorce. Here's the story we see play out time and time again. Let's call them David and Emily. They get married in their 20s, buy a starter home, and have 2 beautiful kids. Like responsible parents, they each get a life insurance policy. David gets $1 million policy through his job, and he names Emily as the primary beneficiary. His kids are listed as the contingent or secondary beneficiaries. This is standard. It means if Emily dies before him, the money goes to the kids. Everything is perfect. But life happens. 15 years later, David and Emily's marriage falls apart. They go through a contentious, emotionally draining divorce. The final decree is 100 pages long, dictating who gets the house, the retirement accounts, and custody of the children. Crucially, the decree includes a standard clause. David must maintain his $1 million life insurance policy for the benefit of his children until the youngest turns 21, to secure his child support obligations. David reads it, signs it, and breathes a sigh of relief that the nightmare is over. He thinks he's done. He thinks the court order magically protects his kids. He's wrong. Dangerously wrong. In the chaos of starting a new life, moving, setting up new bank accounts, and just trying to heal, David never gets around to calling the insurance company. He forgets. It's a small piece of paper in a mountain of post-divorce paperwork. A few years later, David meets someone new, Lisa. They fall in love, get married, and start building a new life together. David is happy. His kids are teenagers now, splitting time between his house and Emily's. Then tragedy strikes. David is in a car accident and is killed instantly. Lisa, his grieving widow, starts the heartbreaking process of getting their finances in order. The kids, now 17 and 19, are devastated, but they know their dad had that life insurance policy. They assume the money will be there for college, just like the divorce decree said. Everyone assumes this. The insurance company processes the claim, and they write a check for $1 million tax-free. They send it, via certified mail, directly to the primary beneficiary listed on David's form. They send it to Emily, his ex-wife. The phone call from Emily to the kids is awkward. Lisa is in shock. This can't be right, she thinks. The divorce decree. It says the money is for the kids. So they call a lawyer. And the lawyer delivers the devastating news. The beneficiary form is a binding contract. The insurance company is legally obligated to pay the person whose name is on that form. The divorce decree is an agreement between David and Emily. It does not and cannot force the insurance company to ignore its own contract. Now, maybe Emily is a wonderful person. Maybe she takes that $1 million, sets up trust for her children, and honors David's wishes completely. But what if she isn't? What if her financial situation is bad? What if she has a new husband who convinces her that the money is legally hers to keep? She is under no legal obligation to give a single penny to those children. To get the money, the children and Lisa would have to sue Emily, spending tens of thousands of dollars in legal fees to try and enforce the old divorce decree against her. It's a legal bloodbath that can take years, with no guarantee of success. David's final act of love for his children was hijacked by a single forgotten piece of paper. He unintentionally disinherited his own kids and handed a life-changing windfall to the one person he probably wouldn't have wanted to receive it. Now you might be thinking, that's terrible, but my state is different. I heard there are laws that automatically remove an ex-spouse. And you're partially right. About half the states in America have what are called revocation on divorce statutes. These laws say that if you get divorced, your ex-spouse is automatically, by law, removed as a beneficiary on things like life insurance and retirement accounts. Sounds great, right? A safety net. The problem is, this safety net is full of massive gaping holes. And the biggest one is a federal law called ERISA, the Employee Retirement Income Security Act. This is the law that governs most employee benefit plans in the United States, including the life insurance policies that millions of Americans get through their jobs. And here is the terrifying part. Federal law trumps state law. ERISA does not recognize state-level revocation on divorce statutes. Under ERISA, the plan administrator must pay out to the beneficiary named on the plan documents, regardless of what state law says. So if David's $1 million policy was through his employer, which it was in our story, that state law meant nothing. The form was all that mattered. The same is true for federal life insurance policies and military SGLI policies. Relying on a state law to fix this for you is a gamble you cannot afford to take. You absolutely must be proactive. So what is the right way to do this? The moment your divorce is finalized, you need to conduct a full audit. Gather every single document that might have a beneficiary: your life insurance from work, any private policies you own, your 401k, your IRA, your pension, even the small accidental death and dismemberment policies attached to your credit cards or bank accounts. Contact each and every institution and request a change of beneficiary form. Now here's mistake number 2, and it's a big one. Your first instinct will be to just write your children's names on the form. John Doe and Jane Doe 50/50th. Do not do this if your children are minors. I repeat, do not name a minor child directly as a beneficiary on a life insurance policy. Why? Because insurance companies cannot, by law, pay out a large sum of money directly to a child. It's not allowed. If you die and your 14-year-old is listed as the beneficiary of a $500,000 policy, that money gets locked up. It will be sent to the court system. A judge, a total stranger, will then have to open a court proceeding called a guardianship or a conservatorship. The court will appoint a financial guardian to manage that money until your child turns 18 or 21, depending on the state. Who will that guardian be? It could be your ex-spouse. Is that who you want controlling your child's entire inheritance with court supervision? Maybe. But it could also be a court-appointed professional or lawyer who will charge fees against the money every single year. The process is expensive, it's public, it's slow, and it gives control of your money to a judge, not to you. And what happens when your child turns 18? They get the entire remaining sum as a lump sum check. Can you imagine your average 18-year-old getting a check for hundreds of thousands of dollars? That money could be gone in a year on a sports car and a spring break trip. It's a recipe for disaster. The proper way to protect your children is with a trust. This is the gold standard. You have 2 primary options. The first is to create a revocable living trust. You work with an attorney to create this legal entity. In the trust document, you name a person you trust, your sibling, a responsible parent, a close friend, to be the trustee. You then spell out your exact instructions for the money. You can say, I want this money to be used for my children's health, education, and support. I want the trustee to pay for their college tuition, a reliable used car, and a down payment on a first home. You can even specify at what ages they get any remaining money directly, say 1/3 at age 25, another third at 30, and the final third at 35, long after they've matured. Once the trust is created, on your life insurance beneficiary form, you don't name your kids. You name the trustee of your name living trust. Now, when you pass away, the insurance money pays directly to your trust instantly with no court involvement. Your chosen trustee steps in and manages the money exactly according to your written instructions. It's private, it's protected from creditors, and it ensures your money is used to build your children's future, not destroy it. The second option is a testamentary trust, which is a trust created inside of your will. It accomplishes a similar goal, but the money has to first go through the court probate process before the trust is funded, which can be slower and more public. For most people, a living trust is the more efficient and private solution. Fixing your beneficiary designations is not just administrative cleanup after a divorce. It is a profound act of protection. It is the wall you build around your children's future. Getting it wrong can lead to court battles, lost inheritances, and family-destroying conflict. But getting it right ensures that no matter what happens, your legacy of love and support for your children will be secure. This is non-negotiable. But what if the tragedy isn't death? What if it's a disabling accident or a debilitating illness that leaves you unable to work? Your ability to earn an income is your single greatest financial asset. It's what pays for your mortgage, your food, and, critically, your child support and alimony payments. If that income suddenly vanishes, what happens then? That question is the single biggest blind spot in most divorce agreements. Because if that income vanishes, the court order for support becomes just a piece of paper. The money stops. The receiving spouse is left with nothing, and the paying spouse is left sick, unable to work, and racking up debt and legal trouble. It's a complete and utter catastrophe for both sides, and it happens far more often than you think. A 35-year-old has a 50% chance of being disabled for 90 days or longer before they turn 65. Think about that. A coin flip. This isn't a rare black swan event. It's a common life-altering risk. So, how do you protect against it? You insure the obligation. Just like you insure the life of the person paying support, you must also insure their ability to earn the income that funds that support. This is done with disability income insurance. Let's be crystal clear. Disability insurance is not health insurance. Health insurance pays your doctors and hospitals. Disability insurance pays you. It's paycheck insurance. It replaces a percentage of your gross income, usually around 60%, if a sickness or injury prevents you from working. It's the policy that keeps the lights on and food on the table when you physically can't go to your job. For the person paying support, the obligor, this is your financial shield. Imagine you're ordered to pay $3,000 a month in combined alimony and child support. Then you get into a serious accident or are diagnosed with a critical illness. You're out of work for a year, maybe longer. Without disability insurance, you immediately default on your payments. Your ex is forced to take you back to court. A judge might be sympathetic, but the obligation doesn't just disappear. Arrears pile up. Interest accrues. It's a nightmare. But with a disability policy, the insurer starts sending you a monthly check. That check allows you to continue making your support payments on time, every time, without touching your savings or going into debt. It protects your credit, satisfies the court order, and prevents a legal battle at the worst possible time in your life. Now, for the person receiving support, the obligee, this is even more critical. Your financial stability is directly tied to your ex-spouse's health and ability to work. Their disability is your financial emergency. This means you have what's called an insurable interest in their income. You have a right to ensure that income stream is protected. This isn't about being greedy or distrustful. It's about being smart and secure. It's about ensuring the funds promised for your housing and your children's well-being are actually there, no matter what happens to your ex. This is why disability insurance can't be an afterthought. It must be a core component of the divorce negotiation, written directly into the marital settlement agreement or the final decree. The agreement should state, unequivocally, that the paying spouse must secure and maintain a long-term disability policy for a specified monthly benefit, for as long as the support obligation exists. The benefit amount should be enough to cover the support payments and, ideally, their own basic living expenses. The decree should also specify who pays the premiums. Typically, the paying spouse covers this cost, as it's fundamentally protecting their ability to meet their own legal obligation. Think of it as the cost of doing business, the cost of guaranteeing the agreement. The decree can even be structured to have a portion of the benefit paid directly to the receiving spouse, or into a trust, to eliminate any chance of the money being misdirected. This creates an ironclad safety net. When you're negotiating this, you have to get specific about the type of policy. There are two crucial distinctions. First is short-term versus long-term disability. Short-term covers you for a few months, maybe up to a year. It's good, but it's not the main event. What we're focused on here is long-term disability, or LTD. This is the one that protects against the career-ending injuries or illnesses that can last for years, or even until retirement. Your divorce decree must specify a long-term policy. The second distinction is even more important, and it's where a lot of people get tripped up. It's the definition of disability itself, which usually comes in two flavors: any occupation versus own occupation. An any occupation policy is the cheaper, less protective version. It generally states that the insurance company will only pay you if you're unable to work in any occupation for which you are reasonably suited by education, training, or experience. Let's say you're a highly paid construction foreman who injures your back and can no longer work on a job site. The insurance company could argue that you're still capable of working a desk job as a dispatcher or a hardware store clerk, and on that basis, they could deny your claim or reduce your benefits. Then there's the gold standard: own occupation. This type of policy defines disability as the inability to perform the material and substantial duties of your own specific job. Let's use a more dramatic example. A surgeon develops a tremor in her hands. She can no longer operate. Under an any occupation policy, the insurer might say, "You can't be a surgeon, but you have an MD, you can teach at a medical school or work as a consultant for us." And they could deny her claim. But under a true own occupation policy, the fact that she can no longer perform the duties of a surgeon is all that matters. The policy pays the full benefit, even if she goes on to earn an income in another field. For anyone with a specialized, high-income skill, a lawyer, a pilot, an electrician, a therapist, an own occupation policy is non-negotiable. And when you're securing a support agreement, you need to ensure the decree specifies this level of coverage. If your ex-spouse already has a group disability policy through their employer, that's a good start, but it's often not enough. Group plans are almost always any occupation. The benefit amounts might be capped, and most importantly, if they lose or leave that job, they lose the coverage. A private, individual own occupation policy is portable. It belongs to them regardless of where they work, and they can't be kicked off of it as long as they pay the premium. Your settlement agreement should require them to have this individual policy in place. The cost? Yes, it costs money. Premiums for a good long-term, own occupation policy can be 1 to 3% of the insured person's annual income, but you have to weigh that against the alternative. What's the cost of losing a $4,000 a month support payment for the next 10 years? That's nearly $500,000. Is a premium of a few $100s a month worth it to guarantee that $500,000 obligation? The answer is a resounding yes. It's the price of certainty. It transforms a fragile promise based on one person's good health into a guaranteed financial asset, backed by a major insurance company. So we've now fireproofed the support stream. We've used life insurance to protect it from death and disability insurance to protect it from illness or injury. These are the two pillars that hold up the entire financial agreement. But income is only one part of the equation. Divorce also involves splitting up tangible things, the assets you built together. The most significant of these is often the family home. And what happens to the insurance on that home when one person moves out, and the names on the deed begin to change? This question of the family home is where insurance gets incredibly complicated, incredibly fast. Because a homeowner's policy isn't just a piece of paper. It's a legal contract tied to ownership, residency, and financial interest. When a divorce shatters that foundation, the policy itself becomes unstable. Let's break down the 3 most common scenarios and what you absolutely must do to protect yourself, because a mistake here can be financially catastrophic. First, let's talk about the scenario where you are the one keeping the house. Your name is going to be the only one on the deed, the only one on the mortgage. This might feel like a victory, but from an insurance perspective, it's a critical moment of transition. The joint homeowners policy that covered you both is now obsolete. It was issued to you and your former spouse as a married couple living together. Now that's no longer true. You must, and I can't stress this enough, secure a new homeowners policy in your name alone. When do you do this? You need to coordinate this with the finalization of your divorce and the official transfer of the property deed. The moment the house is legally yours and yours alone, the old joint policy should be canceled and your new, individual policy should take effect. There should be zero gap in coverage. Not a day, not an hour. Why is this so important? Imagine the old policy stays in place. Your ex, whose name is still on it, could technically cancel it without your knowledge, leaving the biggest asset you own completely uninsured. Or worse, imagine a fire or a major water leak. The insurance company, legally obligated by the contract, issues the claim check in both of your names. Now you're in a situation where you desperately need funds to repair your home, but you can't cash the check without the signature of the person you just went through a difficult divorce with. It's a nightmare scenario that can turn a disaster into a financial and emotional trap. Getting a new policy in your name only ensures that you, the sole owner, are the sole beneficiary. You have complete control. When you call your insurance agent, you'll need to provide the updated deed and divorce decree. They will write a new policy reflecting the new ownership, and you'll likely need to set up a new escrow account with your mortgage lender to handle the premium payments. It's a clean break, and it's the only safe way forward if you're staying in the home. Now let's flip the coin. What if you're the one moving out? This is arguably the more dangerous position to be in, because your risk is split across two locations. For a period of time, maybe weeks, maybe months, your name might still be on the deed and the mortgage of the family home, but you're no longer living there. And your personal belongings are now in a new apartment or a rented house. The old homeowner's policy is a ticking time bomb for you. Here's why. That policy was designed to cover your personal property, your furniture, your clothes, your electronics while they were inside that specific house. The moment you move them to a new address, they are likely no longer covered, or have extremely limited coverage under that old policy. So, if your new apartment building has a fire, you could lose everything with no recourse. Your first call, even before you've finished unpacking, should be to get renter's insurance for your new place. It's incredibly affordable, often just a few dollars a day, and it protects your personal belongings against theft, fire, and other disasters. It also, crucially, provides liability coverage. If someone gets hurt in your new apartment, renter's insurance protects you. But what about the old house? You still have a massive liability risk there. As long as your name is on that deed, you can be sued if someone gets hurt on that property. A delivery person slips on an icy porch, a neighbor's kid gets hurt in the backyard. You are still legally on the hook. Therefore, you need to ensure that the joint homeowner's policy on the family home remains active and fully paid until the moment your name is removed from the deed and the mortgage. You and your ex need a clear, written agreement on who is responsible for paying that premium during this transitional period. Do not just assume they're handling it. Verify it. Ask for proof of payment. Your financial future could depend on it. Once the house is officially sold or transferred to your ex, you need to get written confirmation that your name has been removed from that policy. Only then is your liability truly severed. The third scenario is often the cleanest, but still requires careful management. You're both moving out and selling the house. In this case, you both have a shared interest in protecting the value of the asset until it's sold. The existing joint homeowners policy should remain in full force until the day of closing. The new owners will get their own insurance. Your responsibility ends when the sale is final. But just like the previous scenario, the key here is communication and verification. Both of you are responsible for the premium. If one person is tasked with making the payment, the other needs to confirm it's being done. If the policy lapses due to a missed payment just a week before you're supposed to close, and a hailstorm damages the roof, the buyers could walk away. The sale collapses and you're both left holding a damaged, uninsured asset, facing thousands of dollars in repairs out of pocket. The simple solution is to agree, as part of your divorce settlement, on how the homeowner's insurance premium will be paid until the property sells. Put it in writing. This removes ambiguity and protects you both from a simple mistake that can derail your financial recovery. Now, there's a hidden consequence to all of this that most people never see coming until they get the bill. It's the domino effect of unbundling your insurance. For years, you've probably enjoyed a multi-policy discount. You had your home and auto insurance with the same company, and they gave you a nice break on the price for that loyalty, sometimes as much as 25%. When you split up the homeowner's policy, that bundle is broken. Suddenly, your auto insurance, which you thought was a separate issue, is directly impacted. The discount vanishes, and because you are now considered a single driver instead of a married one, your risk profile changes in the eyes of the insurer. The combined effect can be a shocking increase in your car insurance premiums, at the exact moment when your finances are already stretched thin. Feels like a penalty for getting divorced, but it's just the cold, hard math of the insurance industry. The discount you've been getting wasn't just a bonus, it was a core part of your pricing structure. When one piece is removed, the whole structure has to be recalculated. This is why you can't look at any single insurance policy in isolation during a divorce. They are all interconnected threads in a much larger financial safety net. Severing one thread over here, the house sends vibrations through the entire web and can weaken another thread over there, your car. And that brings us to the other major asset you probably share, your cars. Splitting up the family home is one thing, but untangling your auto insurance policies can be a demolition derby of its own, with hidden costs and risks at every turn. First, let's talk about the title. The names on the car titles and the names on the insurance policy are two different things, but they are critically linked. If your name is on the title of a car, you have what's called an insurable interest in it. You need to make sure that car is insured, period. If you're driving a car that's titled in your ex-spouse's name, you are in a very precarious position. In the divorce settlement, the ownership of each vehicle should be clearly assigned to one person. Once that's decided, you must go to the DMV and get the title legally transferred into the sole name of the new owner. Do not skip this step, because if you get into an accident in a car that's still jointly titled, both of you can be sued, dragging you right back into a legal battle you thought you'd escaped. The next and most urgent step is to separate the policies. As soon as one of you has a new address, you need to split the multi-car policy. Call your insurance agent and explain that you are legally separated or divorced and have separate residences. This is not optional. Why? Because of the named insured. On every policy, there is a primary named insured. This is the person who owns the policy. They have the power to make changes, to cancel it, to receive any refund checks. Everyone else is just a listed driver. Let me tell you about Mark. Mark and his wife split up, and it wasn't amicable. He was the named insured on their joint auto policy. His wife moved into an apartment and kept driving her SUV, assuming everything was fine. A week later, Mark, feeling spiteful, called the insurance company. He told them his wife no longer lived with him and had her and her vehicle removed from the policy. He got a nice little refund for the lower premium. The insurance company is not obligated to notify the removed driver. 2 weeks after that, his ex-wife was pulling out of a parking lot and misjudged the distance, tapping the car behind her. A tiny fender bender. No big deal, right? She exchanged information, went home, and called the insurance number on her card. That's when her world fell apart. The voice on the other end of the line informed her that she hadn't had coverage for 3 weeks. Suddenly, a $500 mistake became a potential $50,000 catastrophe. She was now personally liable for the damages to the other car. She was cited by the police for driving without insurance, which came with a massive fine and a suspended license. And when she tried to get a new policy, her rates were astronomical because she now had a lapse in coverage and an at-fault accident on her record. All because she wasn't the named insured. Do not let this happen to you. Find out who the named insured is on your policy. If it's not you, your number one priority is to get your own policy in your own name for the vehicle you drive, garaged at your new address. Do it the day you move. And that brings up the next landmine, your address. Car insurance rates are calculated down to the specific zip code. They factor in local traffic patterns, theft rates, and accident statistics. When you or your ex moves, the rate will change. If you move from a quiet suburb to a dense urban area, expect your premium to jump significantly. You must be honest about where the car is garaged most of the time. Lying about your address to get a lower rate is insurance fraud, and if you have to file a claim, it will be denied, and your policy will be canceled. And what about the most precious cargo of all? Your kids. If you have teenage drivers, this gets even more complicated. An insured driver must be a resident of the household. So, if your son or daughter lives primarily with you, they should be listed on your policy. If they live primarily with your ex, they should be on your ex's policy. This needs to be spelled out in your divorce decree. Who is responsible for maintaining and paying for the insurance on the car the teen drives? Who covers the sky-high premiums that come with a young driver? If your teen splits time 50-50 between houses, you need to talk to your insurance agent. Some companies will require the teen to be listed on both parents' policies, which can be incredibly expensive. This is a major financial point that cannot be overlooked in the negotiations. So the action plan for auto insurance is clear. Get the titles sorted out. Identify the named insured. The moment you have separate addresses, get separate policies. Shop around for the best rate for your new single status. And be brutally honest about your garaging address and who lives in your household. We've covered a lot of ground in this series. We've walked through the minefields of health insurance, the critical decisions of life insurance, the safety nets of disability and homeowners coverage, and now the demolition derby of auto insurance. Can feel overwhelming. It can feel like just another mountain of paperwork and stress, on top of the emotional turmoil you're already enduring. But I want you to reframe this. This isn't just about paperwork. This is about power. This is about you right now, taking the reins of your own life and building a fortress around your future. Before the divorce, you were part of a team. Decisions were shared, responsibilities were split. Now you are the CEO of You Incorporated, and the Chief Financial Officer, and the Head of Risk Management. These insurance decisions are your first, most critical acts as the leader of your new life. Getting them right isn't just a good idea. It's the foundation upon which you will build everything else. Ignoring this is like building a beautiful new house on a foundation of sand, just waiting for the first storm to wash it all away. The knowledge we've discussed isn't meant to scare you. It's meant to prepare you. It's meant to empower you, to hand you the map and the compass so you can navigate this new territory with confidence. Think of your old, married life as a large ship you co-captained. Divorce is the process of deconstructing that ship. Now you've been handed the raw materials, your share of the assets, your income, your future, to build your own vessel. This series, this information, is the blueprint. It shows you how to build a craft that is watertight and seaworthy. Changing your life insurance beneficiary is patching a hole in the hull. Securing your own health insurance is stocking the medical kit. Getting the right homeowners and auto policies is rigging the sails and reinforcing the mast. Every single choice you make right now determines whether your vessel will sail smoothly into a safe harbor or take on water at the first sign of a squall. And you don't have to build it alone. Your divorce attorney is your navigator for the legal separation, but you need a crew. You need an independent insurance agent who can help you survey your options. You need a financial advisor to help you plan the course. You need friends and family to be your emotional support crew. To make this simple, I want to leave you with a final actionable checklist. Your post-divorce financial fortress checklist. Number 1. The immediate audit. Sometime this week, gather every single insurance policy you have access to. Health, life, disability, home, auto. Lay them out on your kitchen table and read the declaration pages. Know what you have, who is covered, and who is in control. Number 2. The beneficiary blitz. Log into every retirement account, every investment account, and every life insurance policy portal you have. Look at the beneficiary designation. If it's still your ex-spouse, change it. This is the single most important 5-minute task you will do this year. Number 3. The healthcare deadline. If you need to get new health insurance, find out the exact deadline for your special enrollment period. Whether it's 30 or 60 days, write that date on your calendar, put it in your phone, and tattoo it on your forehead if you have to. Do not miss it. Number 4. The quote quest. Your old insurance company is not necessarily your friend. They were loyal to the couple. You are now a new customer with a new risk profile. Get at least 3 new quotes for your auto insurance and your homeowners or renters insurance. Make them compete for your business. And finally, number 5. The professional huddle. Call an independent insurance agent. They work for you, not for one company. Tell them your situation and have them do the shopping for you. A good agent is worth their weight in gold during a major life transition like this. Divorce is an ending. There's no denying the pain and the loss. But it is also, with every fiber of its being, a beginning. It is the rare, terrifying, and exhilarating chance to consciously and deliberately build a life that is 100% yours. Securing the right insurance isn't the most glamorous part of that process, but it is the most fundamental. It's the act of looking your new future in the eye and saying, I value you. I will protect you. I am ready. You've survived the storm. Now it's time to build your lighthouse. You can do this.